Shareholder activism is down this year, but the industry would have seen even steeper declines if not for two prominent funds. Elliott Management and Starboard have launched 25 campaigns in 2019. That's as many as the next 8 activists combined, according to a recent report by Lazard. In the third quarter alone, Elliott deployed more than $5 billion in new campaigns, representing almost half of all the money put to work in activism during that time. In the third quarter, Elliott launched its $3.2 billion stake in AT&T, urging the company to review its portfolio of assets and delever the balance sheet. Elliott launched another campaign at Marathon, pushing the company to split into 3. And Starboard disclosed a 7.5% stake in Box and said the shares were undervalued. Now, despite Elliott and Starboard's pace, about 15% fewer companies have been targeted by activists in 2019 than last year. However, the third quarter did see an increase over last year's third quarter in terms of new campaigns launched. So we're really seeing the third quarter kind of drive the activity for the year, but still demonstrably down from last year.
Okay, so we know Elliott's been super active, especially versus the broader industry right now. Why haven't others been more active?
It's a good question, Morgan, and I think part of it has to do with this idea that one of the key drivers for activism right now has to do with this M&A thesis, whether it's bringing companies together, pushing companies toward a merger of sorts, or breaking them apart. And these two firms are really, really good at that, or at least they believe that they are the ones that should be in the boardroom helping these directors and advising them on different combinations that make sense, especially in a world where you're seeing, lower interest rates, so borrowing has become cheaper. So M&A has, again, been on the table as something that makes sense for a lot of companies, at least in the mind of these investors.
Which is why you just asked Roger how the backdrop is for M&A, and his answer is pretty good given where rates are right now.
Right. Yeah, he said better than the numbers would suggest. He said that there isn't much of an impact on the trade war as it relates to what's driving some of the uncertainty. It's more surrounding global growth, which I think is a derivative of the trade war. I think a lot of that kind of feeds into one another, but it's something that at least these two activists in particular aren't too bothered by.
It does also, of course, the flip side is that dual class share structure that gets talked about and that we see tech companies coming public with. This is the flip side of it, to avoid those activist investors.
Right, absolutely, and it limits the opportunity set for a lot of activists. And so you've seen such large amount of activity within the activist sector over the last few years that a lot of what they call low-hanging fruit in that world has been picked already. And, as you start to see the potential for a recession, as we talked about earlier in the show, as you start to look at, this long enduring bull market, a lot of activists are saying, you know what, I don't actually want to be at the forefront of this and calling for changes and invested in companies that I actually can't exit very quickly.